Good day, everyone. Good Friday to all of you. Not such a bad day for the markets. Trading down a little bit, but could be worse. Always could be worse. I've learned that a long time ago. No matter what happens, things could always be worse, but certainly not even bad today. Dow's down about 1/4%. S&P's on the flat, hovering across the flat line. NASDAQ down less than 1/4%. And the indices really fared fairly well in terms of futures prior to the market opening because the jobs numbers were better than estimates. They weren't great, and we'll get into those, but they weren't bad. And that's what the market was apprehensive about, whether or not the jobs numbers, and even if you break them down, whether there were certain parts of them that were going to be quite negative, and that would impact the market, especially because it's Friday, especially because we're going into the weekend, especially on account of the fact that there is no stimulus, and because Congress looks like it's about to vacation and get nothing done. The president has threatened executive orders to ameliorate a lot of folks' living conditions, and we'll get into some of those harsh conditions shortly. But some of the numbers coming out of the Census Bureau last month, and based on a survey that was just completed, are not looking good and seriously impact a lot of things. We'll also talk a little bit about mortgages, talk about refinancing. We'll talk about what's going on in the housing market. And so we'll touch on home ownership, we'll talk on household income, we'll talk on renters. And so that's the whole picture we'll look at. And they'll do it in a microcosm kind of way in terms of housing and what people are going through with their houses, with their rents, etc. On the other side of that, we're going to have a little bit of a discussion on inflation, because I think you know my prognostication that we're going to start to see a pickup in inflation, and I think meaningfully so come the first quarter of 2021, if not sooner. So we're going to talk about signs of inflation. So we've got a lot to talk about, some numbers to go over in terms of the jobs numbers this morning, what they might mean, and put some relevance to them, put them in perspective, because oftentimes the headline numbers don't tell the whole story. However, that being said, the headline numbers were decent, if not good, because they were better than the estimates. So what were the estimates? The July jobless was called job creation, even though these are a lot of jobs that are coming back online for folks that were laid off. The expected number was an increase of 1.48 million jobs created, resurrected, call it what you want, in July. There was a beat there. The actual headline number came in at 1.8 million. So headline number from BLS, and that's the top line, if you will, of their headlines. Their breakdown starts with 1.8 million on their website. Okay, so that's the headline number. But what I want to say about that is, and I don't understand why, it's a rounded up number. The actual number is 1.763 million payrolls added. So we got 1.763 million jobs added net in the month of July versus the headline number of 1.8 million versus the estimate of 1.48. So net. 1.48 estimate, and that was the middle range. It went from about a loss of 600,000 to a gain of more than 3+ million. So pretty much the middle ground was about an expectation for gains of 1.48 million jobs net in July. So coming in at 1.763, we'll look at the real number, a beat. Okay, so markets like that, futures moved higher in the pre-market, and markets opened up a little bit on the soft side, but really nothing to worry about. And so far, they're just sort of hanging along that nothing to do, thin volume, slow Friday kind of mode. Whether or not that takes another shape towards the afternoon hours, we'll see. But Right now, I don't. There's not much going on there. There's lots of news moving markets and lots of potential news that can break to move markets towards the end of the day into the close. But right now, there's nothing out there that is having any major effect right now. So if the president comes out with an executive order, it'll probably be before the close if he wants to move the markets higher. And we often know that he will make statements and comments, and he will make pronouncements, sometimes via Twitter, sometimes through his emissaries, sometimes directly in press conference form, to oftentimes move markets. So will he do it this time? No, he's got plenty of time to do it on Monday. He might want to see if the markets sell off into the close. If they do nothing, we'll give him even more ammunition next week if the markets need a boost. But they really don't need a boost. They've been performing exceptionally well. The S&P is really just a stone throw away from its all-time highs. And as I said yesterday, I believe we get there where you're going to see sideline money come in, because at that point, you can't be on the sidelines if you're an institution and the market's made new highs. That means you're just not catching the boat. You're left on the shore, and you're no good. So we're going to see that. And oftentimes we'll see towards the end of the month, and certainly at the end of a quarter, we will see institutions move into the names that have gone up because they want to prove that they were in those names for the rise. So again, plenty of ammunition out there. And on Tuesday, I'm going to break down some really heavy-duty numbers for you that should inspire you as to what really is possible in terms of another leg up and why. So I'm going to give you mechanical reasons why. I'm going to give you metrics, actual numbers, so you'll understand where I'm coming from when I say we've got another leg to go higher, possibly a lot higher. That doesn't mean we can't see momentary and day-to-day, week-to-week pullbacks. I don't see a heavy correction. It just doesn't seem to be in the offing because things are too positive right now. And we'll go back to the jobs numbers in a second, but because things look positive, because we're closer to the other side of this recession, because we're closer to perhaps treatment, perhaps a vaccine, by some quarters, by November, maybe around the election, which is hard to believe, perhaps by December, perhaps by early next year. But the expectations and the hopes are for a vaccine to arrive eventually, sooner rather than later. And the markets know that what's on the other side of that is a lot of relief, the economy getting back into growth mode, and good night. Stocks are going to take off. So we're not there, but that's what investors are looking at. They're getting ahead. They've been trying to get ahead, and they have been ahead of all of the news, all the expectations, and all the positives that might come out, including the ones that have come out. The jobs report today looks like a positive. Really, to me, a mixed bag when you break down the numbers. So let me just give you a little bit of perspective on these numbers. Yes, headline numbers, plus 1.8 million new net jobs created. We'll call it re-entered, workers re-entering in July. The actual number, 1.763. Expected number, 1.48. A good beat there. What's interesting, some of the other numbers, if you break those down, the unemployment rate came in at 10.2%. Last month, it was 11.1%. So a 0.9 percentage points drop in unemployment rate to 10.2%. The total number of unemployed in the month over month, June to July, fell 1.4 million people, according to BLS, Bureau of Labor Statistics, to 16.3 million. So the unemployment rate at 10.2% of the working population is equivalent to 16.3 million people unemployed. Some perspective here. In February, the unemployment rate was 3.5%. So at 10.2%, we're still 6.7 percentage points higher. That equates to 10.6 million more people unemployed in July than were unemployed in February before the pandemic struck. So we got a long way to go to get back. Markets don't seem to mind. They seem to think that we're making progress. But really, the progress isn't that great. We're starting to slip back. The numbers, the survey numbers for July ended mid-July. So what we didn't see is the back half of July reflected in these numbers. So we know what happened. We know that there were some more lockdowns. We know that there were slowdowns in economic growth across the country in areas that were locked down, slowed down, where restaurants were closed, where parks and other facilities were closed. So there are things that are happening that are not reflected in this, that happened mid-July onward, and here we are in early August, August 7th, and so none of these numbers reflect that perhaps slowdown yet to happen. So we may see those, probably will see some of that reflected in August's numbers. But again, some perspective. The increase in payrolls in June was a net positive 4.8 million jobs returning. Payrolls back up. May was 2.7 million on the positive side. So those 2 months combined, if we look at those 2 months combined and take the average of those 2 months and we take a look at July, July is less than half of the average of those 2 months. So yes, a positive number at 1.763 million jobs added, but less than half of the average of the past 2 months. So a big step down. I think we need to keep an eye on that, because if we see that continue to slow down, if we see fewer and fewer payrolls added as we go forward towards the election, of course, we're going to see, I think, a lot of rhetoric on the Democrat side and also the Republican side in terms of their platforms. And I think a lot of what we may see is going to start to impact markets. Okay, doesn't mean it's going to turn them around. It means I think we're going to see that volatility I've been talking about start to pick up, and certainly been pretty mellow, because the volatility is always it always is receding, descending in terms of the VIX when you have a steady up, rising, up, turning, up, trending market. That's academic. Fewer investors are buying puts and protection, and so those front month S&P future options on S&P 500 futures, they're not. Nobody's rushing to buy protection because markets are moving higher. So the VIX will come down. And that's what we're seeing. The VIX is now about 22.5. It's down about 0.5% today. So very much on the low end. And that's good, because there's going to be an opportunity to buy some VIX calls. And that opportunity is coming up, I think, fairly soon. So we'll talk about that next week. And I'll give you some metrics as to where the VIX might go and what might be some good bets on the VIX and a way to play them using VIX calls. So that's for next week. We're also going to do, next week is going to be retail week. We're going to talk about retail all week, what's going on in retail, maybe some opportunities to buy some outliers, maybe some opportunities to knock and sell down some of the losers who aren't going to get up. So all next week is going to be predominantly about retail. The following week is going to be real estate. So we've got a couple of neat things lined up for you, and you're going to have some, you're going to be able to digest a lot of really cool metrics, and I'll break them down for you, and I'll actually point to where they are telling me there's opportunities, because there are multiple. So that's retail next week, real estate the week after. That's pretty much it on the jobs. I could dig down deeper and go into other metrics within, including 301,000 government jobs were created in the month. I'm not sure what all those government employees are doing. Maybe they're counting the unemployed. I'm not sure, but so some of the numbers, when you break down, they're just not as good as the headline number of a positive beat would imply. And the markets, I don't know that they're reflecting that. They're more reflecting, I think, today that we don't have a stimulus package, and Congress looks like it's ready to head on for their summer vacation without accomplishing anything. And Larry Kudlow was on Bloomberg this morning, and it was an excellent interview. I think the questions were a little tough, and he was, I think, treated a little bit unfairly and a little bit rudely, I think, which isn't typical of Bloomberg. But he was I think, very elegant and eloquent in his responses. And I got some solace from it in terms of what this administration is really trying to do. And it makes sense. And he was articulate in respect of the differences between what the Democrats are pushing for in the House and what Republicans are pushing back at. The Democrats want a $3+ trillion stimulus package. The Republicans are looking about $1 trillion. Doesn't mean that's the end of it. It just means, why are we going to go for this big all-in deal? We've already put up a $3+ trillion, almost, well, just shy technically of $3 trillion. And the Federal Reserve has added about $7 trillion in liquidity and other support features into the economy to backstop markets. So there's been plenty of money thrown at the pandemic problems. The issue for Larry Kudlow and the Republicans, in particular, spearheaded by the administration, is that the Democrats want to just throw a massive amount of money and throw a lot of stuff in there that doesn't make sense. Republicans want the stimulus targeted to actually help workers get back to work, to help employers rehire, to provide the kinds of stimulus that will facilitate that, as opposed to just helicopter money to look good for vote garnering. So that's my additional input here. But so it makes sense that we have a targeted approach to the stimulus. Throwing money at problems doesn't help. That money is 9 times out of 10 wasted, frittered away, and then you got to come up with more money. By the way, at some point, deficits do matter. They don't matter right now. They haven't mattered for a long time, and they may not matter for a good while longer. But at some point, deficits will matter. And throwing money and jacking up the deficit and the budget deficit, but the overall net deficit is not the way to do it. So we need more targeted, I believe, stimulus measures. And that's what this administration is pushing for. And I think it makes sense. So I'm just seeing now Secretary Mnuchin, Steve Mnuchin, is going to, Mnuchin, as I call him Munchkin, call him a lot of things, stimulus talks at 1 p.m. So maybe we will see something. On that news, the markets really haven't done anything. That just came out now. A couple other things that are not good, that are worrisome. The Census Bureau did a survey of renters last couple months. 27% of respondents missed their July rent payment. 27% of respondents. The latest version of the survey expects that 1/3 of respondents will not make their August rent payments. So we're starting to see very quickly the impact of the flattening of the stimulus and the withdrawal of the extra $600 a week and some of the other programs languishing. So do we need stimulus? Yes, these people are hurting. And are we going to see evictions? No, the president may put a stop to evictions, but it's all of this is throwing into turmoil all kinds of markets, which are fine right now because they're being papered over by the Federal Reserve's largesse and throwing money at everything. So far, this is all, these waves are under the water and there's a nice calm cap on the water. We don't see for the most part what's underneath, but there's a lot of churning going underneath. Into that churning, mortgage creation up until June, till the end of June, totals this year $1.2 trillion. So this is a lot of refinancing. So a lot of mortgages have been made for refinancing. That's a tremendous amount of refinancing and mortgage creation. Typically, the average for the year is about 1.3 trillion. So up to the end of June, and we know this is from lower interest rates, we're at a 1.2 trillion rate already. So mortgage holders are able to refinance. So folks in homes are actually are able to cut their monthly payments. So good for them. Not so good for the renters. I don't think that mortgage holders who are renting are cutting rent to their tenants. So we'll keep an eye on that, but those are not good statistics, do not bode well, and will have some repercussions down the line for sure. So that's kind of really where I wanted to go with some of the numbers that impacted me. The last thing I'll say on numbers is inflation. I read statistics this morning. I was into the CPI numbers and breaking those down. June CPI so far, we're looking at it was up 0.7%, which as a headline number doesn't look good. But sometimes you got to go backwards and take down these numbers, get into them, and separate the wheat from the chaff, so to speak. And you find stuff that's very interesting. What I found was the food at home food, which is actually a subcategory, food at home, right? They measure the rates of inflation of food at home as opposed to eating out, restaurant, etc. CPI there in the June number up 5.6%. Now, obviously, more people are eating at home. Okay, so that's a very large increase, 5.6%. That's month over month. Okay, that's a problem. That's month over month, but based on a year over year figure. So the huge increase from the previous month, and then year over year, up 5.6%. That's all. People are going to start to notice, if they haven't already, that their food bills are getting more and more expensive. So we're going to have to keep an eye on that. And consumers, if they start to see food inflation, their perception of inflation is going to increase, and we're going to hear more about that. There's going to be more news about that, maybe more headline news about that, and that's going to certainly have an impact on markets. So we're starting to see under the surface some of the inflation that I have warned about is percolating, and I think we're going to see increasing measures of that going forward. So those are the basic numbers for us today to break down and take a look at. Let's take a look at the markets, and there's a whole lot of nothing going on here. Dow's down 91, about 1/3%. S&P a little bit lower, less than 1/4%. Nasdaq has taken a little bit of a leg down a shade more than 0.5%, but nothing too major. So those are the basic headline numbers. Going to take some questions. We're going to look at some graphs. And I just want to again tell you that next week we're going to really zero in on retail. The week after on real estate. But on Tuesday next week, we're going to talk about some really interesting numbers. And again, these numbers are going to floor some of you as to what's going on in different markets. And what does that mean for equity markets? And where is the money coming and going? What's happened? Because money flows are really, if you follow the money, you know what's going to happen. You certainly know what's happening when the money is moving. But when you follow the money and the trends, where money is coming from, where is it going to, gives you a very clear picture of what's going to happen next. So we're going to break down those numbers also on Tuesday. So Tuesday is going to be a fun day for us, and we'll also get into some retail stuff on Tuesday. All right, so that's it for my numbers and crunching. I want to see if you guys have any questions and want to talk about any stocks. We're going to do a quick go round, the usual round robin, looking at the markets and see where we're at on everything as we head into the weekend. So let me just see what kind of questions we have. I see Ruby. Hello, Ruby. Is it too early to buy a second tranche of your dividend stocks? No, it's not too early. No, it's not. In spite of the fact that I believe we're going to see a pickup in volatility, I think we're going to have some difficulty digesting some of what's going to happen, some of the back and forth in terms of the election run-up, and there's going to be a lot of consternation as to are we going to see results at the end of the day in November, or is this going to drag out? Is this going to be like 2000? There's a lot of negative thoughts out there. There's a lot of things that are happening that are really ugly. I won't even go into the politics of it because I'm going to start to do a whole series of articles on politics in my Total Wealth. So I hope you guys read that, because I'm going to break down some of the issues, the political issues, and I'm going to break down how some of those issues and how some of the biggest issues facing the country, facing the potential new government is going to, or the new old government is going to impact markets and particular industries. So there's going to be a breakdown there. That's going to start next week on my Total Wealth articles. There's going to be, I'm going to start to zero in on the politics and on the election and the impact that's going to have on markets, on industries, and on particular companies and stocks. So again, keeping a heads up on that. Because there's going to be a lot of good stuff in there, including stuff to stay away from and stuff to get your feet wet with. But as far as the dividend stocks, no. If you are buying quality stocks where the dividend is safe, I'm not talking about energy companies. I'm talking about industrial companies to some degree that have they're not going anywhere. Healthcare companies that aren't going anywhere. There's plenty of companies that aren't going anywhere. Ag companies that aren't going anywhere. Big companies that aren't going anywhere, where the dividend payout ratio is 50% or less. I think there's very little chance that they're going to cut dividends. And those are great. Those are the companies you want to buy because they become defensive plays if the market sees a sell-off. All right, if the market sees a sell-off, there are a lot of folks want to go into those. If prices come down on those dividend payers that you like, that you're starting to accumulate now, you buy more lower. You increase your dividend yields, okay? And they become, again, more defensive plays. So there's going to be a floor under some of those. And there'll be the ones that'll bounce back quickly as long as they have solid dividend yields. And I'm talking about 3+%. That's a tremendous yield. And there you can find some at 4 and almost 5%, which have very, I think, reasonable payout ratios. I would go as high, depending on the cash flow generation and the debt situation and what the debt service might be. I would go as high as companies that have a really good dividend. I go as high as 75% payout ratio. As long as they have a history of those solid revenues, solid net profits, and I look at the net available to common shareholders as my measure of what's important, and they're taking 75% of that to pay for dividends, they've got room. So even at 75% payout ratio, which a lot of folks think is high, I think is reasonable depending on the company and the industry it's in and its history of revenue generation and net profit generation. So yeah, I don't think it's too early to start to buy into your tranche. The other side of that is we may not get much of a dust up. We may get a lot of volatility. We may get a lot of sideways up and down action. Net, we may not get anything close to a sell-off. We may not get anything near a correction by even a long shot. We always could, but if we don't and we continue higher, you want to start adding now because you just don't know. Because if we get another leg higher, we're going to talk about this on Tuesday, what will create this next leg higher. It could be fairly broad and fairly quick. So you don't want to be left behind. So I don't think it's a bad time to start adding to some of those. These are companies you're going to hold anyway. Okay. So yeah. Hopefully that answers a bit long-winded, but I apologize, but I hope it answers your question. Sergio, good morning. Shah, good morning. Love your thoughts on CHW. Let's pull it up. Okay, so CHW beat earnings yesterday morning, but they are getting slammed. CHW, do I have that right? No, CWH. I don't have that right. Okay, I pulled up the wrong stock and I was like, okay. Camping World, wow. Not that bad. Breakthrough support. There was some general support. Looks around 30, about 30, I would say 30, maybe 33. I see some support around 33. Broke through that quite handily yesterday, and it's down lower today. A lot of these stocks again rose because of the pandemic, and the people are going to stay closer to home. There's staycations, and they're going to go camping. They're going to be outside. makes perfect sense. What were their sales? If the earnings were good, great. Okay, we're getting back to opening up the economy against the same narrative, right? Okay, is that done? Has the rise and the rise has been exponential for this company, which really doesn't have much movement. Typically, it just meanders along. It's been meandering along a little higher, but took the COVID dip, of course, and that was ugly because it went from north of 15 down to south of 5, actually to 340 on the low. So that's an ugly move down. Made a nice recovery, and then all of a sudden, with again, this is the narrative. It explodes and it gets up to 42. So hopefully you took some profits. That's the kind of move. I mean, if you were probably in it before. If you're in it before and you're in it and you got up to 15, you were probably happy. If you see it at 40, you should have said to yourself, okay, I got to take something off the table here, especially when it started to maybe turn down. I don't know that this has got a lot of return action to take it much higher. I just think because of the narrative that drove Camping World higher, the run may be over, and I could see the stock trying to struggle to get back up to 35, north of 35. I don't know how much juice it's got left in. I wouldn't bet on it continuing to climb and or make new highs. That's just my opinion of it right now. So hopefully that helps you. Sergio, do you think the 1 p.m. stimulus announcement will move the market? It depends on what it is, Sergio. Yeah, I think it certainly could move the market. Absolutely, depending what it is. So we're going to have to sit on our edge of our seats till then. Peter, SLV down 3% today. Looks like a buy on dip time. Well, let's take a look. We just got ahead of myself on that play, but again, we were lucky because we had a stop on our options puts. Based on SLV moving up to 2350. When it got up to 2350, we got out of our puts. We did take a little hit, but not certainly sustainable, not crying material. I thought it's going to be a hard bet against SLV or gold at any time, Joe, to try and find a dip. If you want to find a dip, here's my opinion on SLV and GLD. Buying dips is fine if you plan on buying more dips because you want to hold it longer term, because I think they both have some more room to the upside. And the way silver is acting, SLV has been acting relative to GLD. We talked about this the other day briefly. There's the retail investors are coming in. I'm starting to look at some of the Robinhood metrics and what retail folks are buying. So SLV saw a huge pickup as GLD was moving higher, and gold stocks, when miners were moving higher. SLV started seeing a lot of pickup in terms of those retail brokerage accounts and activity there, and addition of SLV shares. So yeah, we're seeing retail there, and that just at the same time means that if there's any kind of sell-off, those retail buyers, especially the ones that came in late, are probably going to take profits or try and stem losses by getting out. So there may be opportunities to buy dips on SLV and GLD at times. I would be buying dips with the intention of holding it longer term to get a nice mood out of it. Yeah, this dip today, Again, we put the put play on thinking we were going to see this dip, and then SLV just rocketed higher. So I still expect there to be some comeuppance and some just basically, I would call it backfilling. So yes, I think you want to start here and add a little bit lower. Wouldn't be a bad play. Michael, I get the sense institutional investors are nibbling. You're right, they are. Your thoughts, specific oil and gas industry. Yes, they are starting to nibble. They have to nibble because they have to get in as the S&P, which is the benchmark against which the institutions are measured, is heading towards new all-time highs, at least meet its all-time highs. And if it does, there's going to be more money coming off the sidelines. A lot of it's going to be those institutions having to chase the benchmark, their benchmark higher, because they're not keeping pace with it. And it's been a torrid pace off of the lows. So yes, I think the institutions they're starting to nibble now in anticipation of we're going to get there. And if they think we're going to get there quickly, they're going to nibble hard and fast in order to drive the stocks up, in order to bring other institutions in behind them, in order to create momentum. And this is another thing that is possible in terms of another leg higher faster. So we got a lot of that potential going on. There's a lot. We talked about this on Tuesday. There's a lot of dry powder out there. There's a lot of money on the sidelines. And again, we'll break that down on Tuesday. So yeah, they are starting to nibble. You're right. Michael, please tell us where you get your shirts. This is Robert Graham. It's old Robert Graham. I go into the closet and I have way too many shirts, way too many suits, and way too many clothes. Just when the years I was on Wall Street, not only was I back in the day, you wore a suit every single day. Even when I was on the floor in Chicago, I wore a suit. I mean, there were only a handful of guys, and I'm talking about the early 80s, that wore suits on the floor. I was one of those guys that just wore suits. I had my jacket off, of course, and I had my trading jacket on when I cleared through Goldberg Brothers back then in the early 80s. And so it was a blue jacket, and just always was a bit of a, clothes buff, clothes horse, and I get that from my dad. So a lot of old stuff. This is old. I don't know how old this is, but thank you. Who will be buying the huge T-bond sale next week? Wow, that's a great question. I think that we're going to see institutional buying. There has been a lot of institutional buying of bonds. Part of the reason we're seeing the yield on the 10-year has backed up. I saw it at 0.56 today, and we were down at 0.52 early in the week, 0.51. We would look like we were going to head back down to 0.49 and break that record low in yield, but we've worked our way back up, which often happens, by the way, because I used to trade bonds, will often happen because the buyers want yields to go higher, right? They don't want to drive the price down and the price of the bonds that they're going to buy higher in the primary market. All right, they kind of step back, and some of them will even short some bonds to try and knock the prices down so yields come a little higher. So when they go in on the big auction, they're going to buy at a reasonable level and not bid it up the price of bonds coming to market on themselves. So you'll see that oftentimes before big auctions. And that's just how the bond market works. That's how these guys trade. And it's smart, and it's very typical. And it's probably part of what we're seeing right now. I think there's a lot of institutional buying likely to happen. I don't know that there's going to be a lot of foreign buyers. And that, remember, I'm looking forward to seeing what the bid to cover ratios are going to be on each of the issues, and looking forward to seeing what the foreign engagement is going to be like. If it's a lot less than expected, then we're starting to see a foreign strike, meaning that starting with China, they may not be in buying treasuries as a way to slap back at the United States, doing some of the things that the United States is doing against China. So we're going to start to see an increase. We have seen an increase in this, what I call saber rattling, and that may be part of it in terms of Chinese not buying so many treasuries as they typically have done in the past. They've already slowed down significantly. So we may see less foreign buying, but we're going to see institutional buying. Why? Because the Fed will buy those if there's a problem. Institutions know that. But the institutions are also, there's increasing talk. If you're not aware of it, I'm telling you now, because I have my ear to the floor on a lot of things in a lot of places, and there's increasing talk of yields actually going negative. And we haven't seen that in a while. And even though equity markets are, as shall we say, ebullient as they have been, there's still talk and increasing talk that yields are coming down and going to go negative. So if you're an institution, you're going to buy bonds simply because the bonds you hold are going to go up in price as yields go down. All right, so that's where a lot of that buying is going to come from. So I don't see it being a weak auction. If it's a weak auction, that would surprise me. I think there's going to be strong buying, but that remains to be seen. Great question, Peter. Uh, John, Trump order for China sanctions will cause tech stocks to drop a bit. Yes, it already is impacting some of them. Needs to be done, but it will hurt. I agree. I agree with you, John. It needs to be done. Hopefully, this administration does it judiciously, which is perhaps a big ask, but I think it should be targeted. The TikTok thing, I don't have the expertise or knowledge to know really whether TikTok is a threat to national security and what they're doing with our data. I can only imagine that it might be, and in which case, if it is, or Huawei, same thing. I think we need to err on the side of being cautious in terms of national security, in terms of our data, in terms of all kinds of things, because the Chinese, well, they're not exactly straight up players. We know that. They never have been. It all looks good on the surface, but the Chinese are certainly doing all kinds of things. There's one little anecdote that maybe some of you remember. And somebody, if you do remember, shoot me this. Years ago, and I don't even remember how long ago, there was a product. This was the first this is how I grasped the gravity of what was going on, that I had no idea. And when I first heard this news, I thought it was stupid. And then when I thought about it, I thought, this is frightening. Years ago, there was a product that became very popular. It was a little device that you put, I think you downloaded pictures from your computer into this device, and it would just sort of rotate through the picture. So you had this nice little thing on your desk or somewhere in your living room, and the pictures would sort of just rotate through. So it was pretty cool. I didn't get one, but I read about it, and it was all quite the rage, and how pretty cool idea. It's really smart. Except the Chinese, the manufacturers, were stealing the data from people's computers as they downloaded the pictures in there. And I don't think a picture company wants that data. I think it's the government that wants the data. So it wants to be able to hack into people's computers, and also so. At first, I thought, well, that's ridiculous. What a stupid thing for the company to do, until I realized I was stupid. It wasn't the company that was doing it. The company was probably a front for the government trying to find and break into computers. And I realized this is years ago. This is where we've come to, and we're already there. So has it gotten worse? Of course it's gotten worse. Are the Chinese doing what everyone thinks they're doing? Not only probably, I would say most definitely. So is it going to impact Chinese stocks? We're going to push back? Is the administration going to put back on listing of Chinese stocks here? Yes, they're going to do a lot. Is it going to impact? It's going to be a positive and a minus. Some of the stocks that are listed here may get delisted. We're far from that yet, but you'll still be able to buy them. Okay, it may even be better, because if they're trading in Shanghai, if they're trading in Taiwan, if they're trading in Hong Kong, you're going to be able to access them. And the Chinese government is going to make the U.S. look stupid, and they're going to make sure those prices soar. So that might even be better. I wouldn't worry about that. But you're right. I think we're going to see that, and when that's part of the saber rattling. So right now, I think we're seeing it in Alibaba. I noticed a couple of stocks today getting hit on that, but Baba's down 4.5%. There's a lot of them. Probably JD. Let's take a look at. They're taking it on the chin a little bit, but no one's going to get knocked out by that. JD down 4.5. JD.com. So we're going to continue to see that. Thanks for bringing that up. Michael, if they are publicly traded, how can dark pools be legal? You kind of a little broken up there, Michael. I'm not sure. If they are publicly traded stocks, I presume Chinese stocks, how can if you wouldn't mind just maybe getting me a little bit clearer question, because it's broken up. You got dark pools be legal. If you want to talk about dark pools, I can talk about those all day, but I'm not sure about the publicly traded part. So give me a little further heads up on that, por favor. So If you guys have any more questions, send them on. I'm going to just do a quick round robin on the charts. Just going to be fast and furious. We're just going to take a look and see if there's anything that warrants our concern. So let's go to the video screen. All righty. Survey says, first up, the SLV, the Silver Trust iShares we talked about earlier. You know, a little bit of a come down here. So if you want to buy the dip, I think we could get it. If the market just drifts lower even, and it's not drifting lower, it's as I'm speaking, it's making a tiny bit of a bounce. We're far from over in terms of the day, and we don't know what this announcement is going to be at 1 o'clock, et cetera, going into a Friday. If it's a negative, if it's not a positive announcement, will stock sell off? Possibly. How low can they go? Not that low. There's nothing horrendous out there that we don't already know. So yeah, SLV, I would expect that if we see some net selling, some profit taking, we're going to see some selling in SLV and maybe a little bit more in GLD also. So yeah, it still looks pretty good. This heck of a rise up here. Here's the entry of retail starting in here. Retail pop, and all of a sudden GLD is gold in general is breaking over 2,000. And bam, we've got a lot of retail interest all through that period. So continues to probably be strong. GLD, again, I think long-term hold. We own GLD in one of my services, have had for a long time. My only regret is that we didn't buy more. It's always that way with winners, right? So the GLD, down a little bit today, but really nothing to worry about. We got that gap. I'll leave that up there for us to reference. Are we going to get down to that gap? If we do get down for some reason to close that gap, it'll be because there's a sell-off and there is a tremendous amount of correlation in terms of portfolio holds. GLD's in everybody's portfolio these days, and it's going to get taken out if there's margin calls. So yeah, if we get down there, that's a buying opportunity, and I would buy certainly more on any dips, because longer term, we're going to see inflation. We're going to see continue devaluation, I think, of the dollar, and that all bodes well for gold. So long term, there's no reason not to own some gold. Real quick, we just have to take a look at the FANGs and Microsoft just to see how they're faring. Facebook, I think Mr. Zuckerberg hit the $100 billion mark today. So he's probably going to open up a bottle of champagne. Not bad. I was thinking earlier, I wonder what it was like to be Mark Zuckerberg when he made his first $1 million. As a kid, it's like I just made $1 million. Can you imagine what he felt like when he made $100 million? $100 million, and he's still a kid. Can you imagine what it felt like when he was worth $1 billion? $1 billion. He was probably beyond excited. Now he's probably thinking, 100 billion, whatever. Insane, isn't it? America, what a great country. Facebook, absolutely fabulous. He comes back down into this range, folks. You got all this support down here. If you don't own it, you want to own it. If we get any kind of sell-off, let's hope we do, because if you don't own it, you want to start buying it anywhere along in here, because it's going higher. This is a tremendous consolidation phase for it after it may just move up, after it had already been moving up beautifully, and then it consolidates here at a much higher level and continues higher. This is going to continue to happen, folks. You don't own Facebook, look for a place to get in. Amazon, same thing. Where's this company going? Nowhere but up. I mean, it does everything right. It's got such tremendous constituent parts to it. Just brilliantly run. And the most important parts to me are the data that the company collects. Just can't even put a price tag on it. So yeah, here we go. Here's another little nice consolidation phase. Look at this. Just, are you out of your mind? Oh my goodness. This stock is just like, whew, it's insane. Gotta love it. Here, this is a consolidation phase, similar to what we saw in Facebook. Anywhere down here, consider yourself lucky to buy in. If you get lucky and if you buy in here and it goes lower, don't fret, buy more. Where to go but up? Apple. The question on Apple, and I was asked by a very dear friend of mine, is, well, more than a dear friend, what should they do with their Apple? Once it splits, should they sell half? My response was no, but it's not a bad idea as long as you take half and put it into something else like Amazon, like Facebook. Otherwise, you're never wrong diversifying to a degree as long as you're putting your capital, spreading your capital out into other high growth stocks, because Apple's a high growth stock, tremendous cash generation, on. And Apple, believe me, forget about the phones, forget about the things you're worried about. They'll manage all through that. That stuff is still great, but the services are increasingly a larger and larger part of their revenue. They're not up to the iPhone sales yet. They're going to get there. And Apple, with its wearables and everything it's got, Apple's just starting to get going. So don't fret about Apple. Just well-run company, absolutely beautifully run company, and going a lot higher. This is a little bit of a jump right here for good reason. For good reason. So, but could there be a little bit of consolidation coming back down to here? Yeah, if you don't own it, you want to look for it. If you come back down to $3.99, somewhere around that range. Which again, if we get a sell-off, it could come down there very quickly, simply because there's a lot of people that actually chased it up and bought it up here, and they want to cut their losses or take any profits that they have quickly. If we see the general sell down, Apple will get taken down a little bit with it. And if you don't own it, there's a buy-in spot anywhere along here, anywhere down here is a huge buy-in opportunity. We don't really talk about Netflix much, and I know some of you probably own it. Again, there's nothing wrong with this company. Just seems to be doing everything right. I worry about them becoming a studio and what has happened to studios in the past. The volatility that they experience. But Netflix, you can't help but still like it. The stock is doing really well. You got this nice uptrend here. So if you own it, I would stay with it. You're right down around here. If you don't want to own it anymore, it might be a place to take profits in like the 470 range if you get down there. If you like it and you want to own it, and we get a little bit of volatility, the stock could come down to maybe the 400 range, somewhere down there, in which case I would say buy it for sure. But otherwise, you know what? Leave it alone. Leave it alone. If it's working for you, leave it alone. Just be mindful of big sell-offs. And if you want to take your profits, you know me, I'm all for ringing the register. Just get back in. If you're right and you take your profits and the stock dips hard and fast, brilliant. Reapply the capital lower. Brilliant. That's what in a perfect world, that's what you do. Not a perfect world, so good luck with that. Alphabet, same thing, just consolidation again here, which is excellent. Alphabet had the hardest time, I think, at the hearings last week. Alphabet also is having the hardest time in terms of its ad revenues. So you're going to see Alphabet not be as robust in terms of its next move higher as some of the other stocks, but still, you don't want to bet against Google, period. Microsoft, my favorite, just because, probably my favorite because I loved the stock when it was in the high 20s. And I'm going to be honest, I love the stock because I called it so right and my timing was so right on it. And the reasons for me liking it and buying it and for it to appreciate, I was spot on. And so, yeah, I like being right. I'll admit it. And that's another reason I like the stock, because I love the company, because I love the management, just like Apple. Got to love it for the management. Facebook, lucky Mr. Centibillionaire. I don't think he's the best guy to be running Facebook, but he certainly isn't bad. But you got to love Tim Cook. You got to love Satya Nadella at Microsoft. Just brilliant. And the guys at Google aren't so bad either. So those are the movers and shakers. Synaptics, we talked about that. Sweet. And I know hopefully a couple of you picked it up. I know a couple of you did. So, and thanked me for it. So I'm very happy. Love that move. By the way, think we got higher to go. The stock could come down, consolidate a little bit, move down here. I think it's got a good bit higher to go. All right. Let's see if you got any questions. And we're going to call it a day. Okay, on the question side, let's take a look. Dark pool tech. Michael, I apologize. You've got a couple different, you got dark pool legal, if they are publicly traded, dark pool tech, you got cut off there, and sorry, no. All right, so let me just jump in real quick, and I'm going to anticipate your question. If I'm wrong, I apologize. Dark pools, are they legal? Yes. Should they be legal? Yeah, that's debatable. I would like it if there weren't dark pools. I would like it if there weren't so many exchanges. I think that it's gone way too far, and I think it's. I understand the reason for dark pools. People want anonymity when they trade because of the structure of the markets now. But what happens in dark pools also is the stuff that people are running to dark pools to avoid happening, which happens in regular markets where HFT and the actual desk you send the order to are reading the orders. It happens in dark pools too, folks. They're not all up and up. And a lot of folks think they are. There's a couple of cases not too long ago. I'm not going to name names because I don't want to be chased down by their lawyers. A couple of huge names that run dark pools. Yeah, they were found out to be looking into the dark pool. Say they weren't so dark for everybody. They shone a light in there, and they were trading off the flow of orders. So yeah, it happens. Should they be illegal? I would say yes. They should. I don't see the need for them. The market should be structured differently, more fairly for everybody. John, IIU, yes, another play for gold, yes, and that's a great one. And the thing about IAU is it doesn't get quite the activity that IIU we're looking at today right now, 19,864,000. But traditionally, not traditionally, but for the last many years, GLD has taken precedent. IAU is catching up. GLD again go to, but IAU was long before there was the rush into GLD. People played the IAU. They played the iShares Gold Trust, but it's coming back in popularity. And now it's a trade-off between whether you want IAU or GLD. I think they track each other fairly closely. I'm not sure which one's better. I have to take a look and see how they're constructed, how the trust is set up, and where they hold their gold, and et cetera, et cetera. But I would say they're both pretty decent. Have a good ETF that has the FANGs in it. QQQ. Peter, you can't go wrong with QQQ. You want to play all of those stocks. You play the NASDAQ 100. You play the QQQs. That's what you play. It's simple as that. You can't go wrong there. That you're going to get the most bang for your buck there, and you're going to get some degree of diversification, and you certainly have an immense amount of liquidity. So plenty of room to move in QQQ. And what I like about QQQ, maybe the best, is the spreads are pretty tight, so it's easy to move in and out of QQQ. MODN. Let's take a look at Model N Inc. MODN, don't know it. Certainly had a nice rise. Got beaten up into COVID, but certainly made its way higher. Looks the chart looks good. MODN, we're gonna have a quick look at it for you, Peter, and see if everybody else might or anybody else might have an interest in it. Model N Inc. Okay, I'm just going to have a quick look. Let's just see what it does. San Mateo, California. Revenue management cloud solutions for the life sciences and technology companies. Cloud-based revenue management solutions include Revenue Cloud for pharma, Revenue Cloud for, sounds like a very good business. Friend of mine out in California just sold his software business. He's in his software does cash management for companies, a lot of big clients. It's a hot area. So anything that helps these companies manage revenues, manage cash, manage any of their P&L balance sheet items, inventory, on and on, that's in the cloud is hot. So the stock has done well. Let's take a look at the statistics and see how it pans out. Does it make money? Loses money? 15 million downside. Reasonable debt at 116 million. Cash flow is reasonable. Cash at 100. Yeah, looks interesting. Typically, and what's perhaps one of those things that I always like to look at real quick in a company that's losing money is, does it have what's its debt and cash position? What's the cash flow look like? Are they able to manage their debt service easily enough? And given their cash flow, the answer is yes. Given their cash on hand, the answer is yes. The rest of the statistics don't look good, but the trend looks like it's improving. And another thing I like in a stock like this, and what's been helping it, is it's generally probably going to continue to have a decent short bet against it. The percentage short of float now is about more than 8%. So you're going to get pops if and I think the companies, it looks pretty decent to me. It's one of those companies that I don't jump on a lot of these companies that when they're losing money. I'll often wait. This one, I would have missed a lot of the stock move, but you obviously get you've got a handle on it, and hopefully you own it because it's done really well. I think it'll continue to do well. So that's my opinion of it. Good luck with it. Kelly, is Renaissance a good buy? Renaissance? Which Renaissance? There's lots of Renaissances. So give me a heads up on that, and then we'll take a look at it. But there's lots of Renaissances. So if you give me the symbol, we'll know which one it is. And as I'm heading out the door with you guys, we'll take a quick scan over the markets. The Dow is clawing its way back up. It wasn't beaten up badly today, but certainly we're close to a flat line on the Dow, just down a tiny bit. I think it will be up, down, for the next few minutes, right on that flat line. S&P just turned positive by a tiny bit. NASDAQ is still sort of meandering along its lows of the day, down about 0.5%. Just hasn't been able to turn that around. But all things being equal, just no damage being done here. An ETF. What's the symbol, Carrie, if you don't mind? And I'll take a look at it by symbol. So as we head out the door and we're looking at the markets, we're news driven, but there comes a time where there's a lot of news stuff that you would expect to drive the markets, and sometimes the big news story is the one that supersedes all the other stories. And the big news story right now is stimulus. And secondary to that is what's happening with the U.S. and China, and what's that relationship looking like? How badly is it going to deteriorate, and what is going to result from that? So, Renaissance IPO ETF. I'm going to look it up real quick because I don't know what you're talking about, Carrie, and I apologize. See if I can find it. Renaissance Capital, IPO investing. I'm going to have to look into that. So I'm not sure what they're doing. Renaissance Capital, the IPO expert. Don't know anything about it. So I'm going to look into it and we'll talk about it next week. So remind me of that, Kerry, next week on Tuesday. I'm going to write myself a little note here. Could be interesting. So thanks for bringing it up. Last but not least, I'm going to give it to Big Mac, GTBIF. Let's go take a look at GTBIF, which is the Green Thumb Industries. Wow, stock has done really well. Kind of meandered sideways for some time and has taken off nicely. COVID dip down to 369, looks like. Now up at 1450. So had a very nice move. Hopefully you own it, Big Mac. Got to stay with it. If it's the Green Thumb Industries, it's the outdoor plants and all that good stuff that I drive by. A lot of people doing gardening, a lot of people getting into that. A lot of people staying home and sprucing up their yards, gardening, farming. And I think Green Thumb is going to probably continue to do well. So if that's what they do, I'm going to have a quick look because I apologize, it's a stock that I don't follow. GTBIF. Just have a quick look at the numbers. Lose money. Leverage free cash flow is negative. The numbers don't look so great. Manufacturer, distribution, sells various cannabis products. Okay, and medical adult. Well, good luck with that. I thought it was the Green Thumb, the gardeners and stuff that there's lots of companies, lots of Green Thumb places around where I live. Thought that was it. But this is cannabis of medical adult use in the United States. It offers cannabis flower, processed and packaged products, including concentrates, edibles. Here's my story on that. Maybe I should have figured that out when I looked at the statistics. I'm all for cannabis. I'm all for it. I think it's a huge growth industry. There's no question about that. The only question I have is who are the real players going to be? And I don't know. The market value of this $2.8 billion. That's a huge value for a company that's losing money. Are they going to be one of the winners? I hope so for you. I'm apprehensive about the names in the cannabis because I don't know. I don't research them. And so I really can't speak to them, I would say intelligently even. I just don't have that breadth of knowledge on them because I don't follow them. I should, but I've sort of held off because I started to in the beginning, and there was just so much garbage out there, and I just thought, well, I'll wait till things sort of shake out, and if they're starting to shake out, then it's time for me to start getting into them. So thanks for bringing that to our attention, and I apologize that I got that one wrong. Last but not least, Marvy, Sandra is asking, what should I do about my call on Fastly, F-A-S-L, on Fastly? I don't know. Is that the symbol? F-A-S-T-L-Y. So again, give me a little heads up on that, please. Is it Fastrenol you're talking about? If it's Fastrenol, I like that stock a lot. If it's F-A-S-T, then I say stay with it. Stock's just doing great. So, F-S-L-Y, okay, because I know I've talked about Fastrenol before, and I recommend we have it in one of our services, and it's great. F-S-L-Y. Fastly Inc. Wow, don't know this one, down 9.3% today. A lot of flatlining for a long time, and then bang, absolutely just takes off like a rocket. Holy mackerel. Hopefully you own this down around 10. If you do, my hat's off to you. I don't know this one, so let's have a quick look. Okay, we got another one of these crazy companies that loses money. But at the same time, what I do like about it is it's got $30 million in debt and $384 million in cash. The problem I see quickly is that operating cash flow is negative, leveraged free cash flow negative by more than 100 million. I don't like that. Short, it looks probably continues to have a lot of folks shorting it. Short of float, the percentage is 11%. So you're going to see moves up, and a lot of short covering will continue maybe to move the stock higher as it has for other companies. Profit margins grossly negative. Revenue 246 million, loss of 50, almost 53 million on that. Statistics aren't great. Certainly had a heck of a run, and let's see why. Because operates edge cloud platform for processing, serving, securing customers' applications. The edge cloud is a category of infrastructure as a service that enables developers to build, secure, and deliver digital experiences at the edge of the internet. I don't know what that means, at the edge of the internet. It is a programmable platform designed for web and application delivery. Well, that sounds, of course, positive. As of December 19, the company's edge network spans 68 points of presence worldwide, serves customers operating digital publishing, media, entertainment, technology, online retail, travel. Well, sounds interesting, but founded in 2011. It was SkyCash, changed its name to Fastly Inc. in May 2012. Founded in 2011, headquartered in San Francisco. I don't know when it IPO'd, but being in that part of the business, you would think by now that they would have a pretty good handle on making money. So why they're not making money at this point, I'm not so sure. Certainly the stock has done really well. There's some support at 75. If I own this thing if you own it at 10, 15, you're a hero and a star. I just wouldn't let too much evaporate, because below 75 is looking a little shaky. So we'll keep an eye on it for you, and hopefully maybe you've already taken some profits, but I don't know if I would think this has another run in it. It just looks like it's broken down. So be careful with it. Let's see, any sign it's going to go up by 8/14, by August 14. You must have some calls. If the market, I would say the market's going to have to firm up and really move higher. And the shorts in here then may have to cover. And if they get nervous, so I guess maybe you're looking for earnings. If they have a beat, then I would say stay with it. If you think they're going to beat on earnings, if that's what your destination point is, the earnings, then I would say stay with it. Below 75, depending on what you own it at. If you own it a lot lower, below 75, I would probably take my profits. If it's an options play, the way I play options, if you're waiting for that date and you think it's going to be an earnings release based on the way the stock has moved, I would take my shot and stay with it. Could it get back up? Yes, it could. But it also could come down to 75, could consolidate, and you may not have enough time if it does fall and consolidates by the time you want it to move by 8/14. That might be a big ask, depending on what your strike is or what you need the stock to go to. It's lost a lot of energy. So hopefully that helps you out. Hey, buddy, thanks for being with me. We'll catch you on Tuesday. A lot of cool stuff to talk about on Tuesday. Have a great weekend, everybody. Be safe out there, and let's see what happens in a minute from now. All right. Cheers.